Okay, in this video I'm going to be taking you through the difference between tax concessions and accelerated depreciation allowances more generally, and I'm also going to be talking about the difference between market and interventionist approach to supply side policy. It's something we didn't spend enough time on. It's really important going into your exam, so I'll be talking about it a lot more in this video. Just one question to start off with. It says here, over 2017-18, interest rates on home loans decreased by approximately 10 basis points. This means what? Okay, and the correct answer to this question is, it doesn't mean a loosening of monetary policy. This is the answer most people would go, but it's not that, because it's not saying that there's a direct change in the cash rate. So in terms of this question here, again, the monetary policy stance has become expansionary. It's also not true. The correct answer is that none of the above statements are correct. None of these, it's nothing to do with budgetary policy, so it's not C. And A and B occur when the RBA lower the cash rate, but because this isn't directly saying they've lowered the cash rate, you can't be sure that it is an expansionary monetary policy stance. So if it's just the amount of the interest rates on home loans, then be mindful that it doesn't necessarily mean a loosening or a more expansionary stance. So make sure that you look at that carefully. If it's just on home loans, or if it says commercial interest rates, that doesn't necessarily mean a loosening. Alright, secondly, when you're going to get questions about to explain how research and development promotes supply, both accelerated depreciations and tax concessions. Now be mindful, accelerated depreciation is a form of tax concession. There's just two separate ways in which tax concessions to work. The tax concessions for R&D work a little bit differently to the accelerated depreciation allowances. So in regards to accelerated depreciation allowances, the key thing here is that firms are able to immediately expense any assets they purchase that are worth up to $20,000. So what that means, if you invested in a new car or invested in your machinery or a new oven or anything like that, in the past, those transactions couldn't be recorded as expenses. So when you buy assets or you buy physical things, in the past you couldn't record it all as an expense. You might expense it slowly over its life, but it couldn't be recorded as an expense. So what the government's allowing you to do for the last 3 budgets, and this is a key policy for growth and jobs, if you purchase any asset, say a car, you can immediately record it as an expense. This helps you to lower your taxable income, and that means you can save money in tax. So for example, if you earn $900,000 profit and you buy a $20,000 car, you can immediately claim it as an expense, reduce your profits to $880,000, and essentially you'll save 30% of your $20,000 purchase in tax, which means you'll get around $6,000 back. So the key thing is accelerated depreciation allowances allow you to immediately expense assets. Tax concessions are a little bit different. They allow you to claim more than what you actually spent for other expenditure. So the difference is that research and development is a form of expenditure, and you're always able to claim expenditures against your profits. So unlike purchasing assets, they're always recorded as expenditures, but in this case here, you're able to claim more than what you actually spent. So the tax concessions for research and development, 150% tax concession, the dollar sign shouldn't be there, means that you can claim that you spent 1.5 times what you actually did. So if you spend $50,000, you can say you spent $75,000, and therefore reduce your profits by $75,000 instead of $50,000. This helps to lower your taxable income, and again helps encourage people to invest in research and development. So both of them work in slightly different ways. This one allows you to claim things as expenditure that you normally wouldn't, and this one allows you to claim expenditure, but it can claim more than what you actually spent because it's associated with research and development. Okay, something we haven't touched nearly enough on, and it was part of your homework, but I want to go through it in the holidays, but I want to just go through it again. So if you get a question on market versus interventionist policies, that you're feeling comfortable with this, because it is listed not in the key knowledge of the study guide, but it is in the preamble and is also listed as a key skill. So it's really important that you know examples of market versus interventionist policies. I doubt they would ask you a really difficult question, but make sure you go into your exam with really key examples of market versus interventionist policies for supply. So all supply side policies are designed to boost our productive capacity or our potential output, and they do that by increasing the quantity or quality of resources. But some policies are interventionist, and interventionist means the government's intervened, whilst other policies are market-based, which means that relate to demand and supply, and basically they involve policies related to the government actually leaving the free market alone. So in terms of interventionist policies, basically interventionist policies are initiatives that would either not occur without government intervention, or they would occur at a suboptimal level. So the government's intervening in the economy to ensure that that people are investing at an optimal level, for example. So interventionist policies are often related to market failures that prevent the economy from reaching their potential. So, for example, an interventionist policy, the government actually physically doing something, is a subsidy. The subsidies are given for research and development, and that prevents us from under-allocating resources to research and development because, as you know, producers and consumers don't consider the positive externalities or the third-party benefits of production and consumption. So the key thing is with research and development, we provide the subsidies, which then allows us to produce at the optimal level. Subsidies lower firms' costs of production and they encourage investment by the private sector, and that helps to boost productivity, reduce costs of production, and boost aggregate supply. So if you're looking for an example of an interventionist policy, again, it includes things like infrastructure and things like that, but tax concessions and subsidies are a form of interventionist policy, and they're generally designed to reduce market failures and ensure that we produce goods and services at the optimal level. The free market would also underinvest in things like education and infrastructure. So again, these are interventionist policies because the government promotes them because they have social benefits for society. So for example, with education, that helps to reduce the cost of schooling and encourages training and education to the socially optimal level. This ensures there's not an under-allocation of resources to education and a higher quality labour force going forward. The idea is to promote aggregate supply, but also because there's positive externalities. So subsidies, education, infrastructure are all interventionist policies because the government's stepping in to provide these products or these services because without their intervention, they would be under-allocated in a free market. Some subsidies, just in terms of analysing interventionist policies, you sort of look pros and cons. The main cons for interventionist policies, they often cost the government a lot of money, so they are policies that require a lot of outlay. They generally promote efficiency in supply, but not always. So good subsidies that are used in a temporary fashion, they often be used to promote research and development, to encourage the growth of young, dynamic businesses. They can also be used to promote competition, whereas bad subsidies would be subsidies like protectionist subsidies that prevent us from shifting areas, prevent us from shifting resources to areas of comparative advantage, or protect industries where we don't have comparative advantage. The problem with these is they can often lead to inefficiencies, and removing those subsidies is often better because it makes us more efficient. So when you see the word interventionist policies, if it does come up in your exam, don't overcomplicate it. It's just government initiatives, subsidies, education, infrastructure. We've talked about them all, and you need to evaluate the pros and cons. Generally, they're pros because they can boost the quality and quantity of resources. The cons would include the fact that they can encourage inefficiency if they're bad subsidies, and the fact that it hurts the government because it costs a lot of money, so it can hurt fiscal consolidation. Market approaches, so interventionist government approaches. The government does something physically and intervenes in the market. Education, infrastructure, subsidies, tax concessions for research and development. Market approaches is basically when the government steps in and says we're going to actually leave the market to itself. So the government removes their involvement in the labour force or involves their involvement in the market. So the idea is to increase efficiency and boost aggregate supply, but it does this by often removing government intervention, exposing businesses to more competition in order to try and boost efficiency. So examples of things that market-based approaches, where the government says we're not going to intervene anymore, is something like deregulation of the labour market. So that includes removing government intervention in the labour market. So that might make it easier in terms of removing unfair dismissal laws, making it easier to sack unproductive workers, privatising companies, so getting rid of government-owned companies and making them privatised. A more simplistic one, which we've talked about, is lowering income and company taxes. So tax reforms and welfare reforms are good examples of market approaches because they involve the government removing their or reducing their intervention in the economy. Removing other regulations like minimum wages and health and safety and things like that can also be included. So it's about the government removing their intervention, have some clear examples, removing unfair dismissal laws, privatising businesses, reducing income and company taxes. Many of these policies that were in place to improve equity, like the minimum wage, so often these market approaches represent a trade-off between increasing efficiency by getting people to work harder and promoting productivity and participation and things like that, but they often come at the expense of equity because they may hurt low-income earners. So removing income and company taxes, for example, increases the incentive to be more entrepreneurial, to work harder, and to invest for companies. This should boost productivity and efficiency and boost our productive capacity. Deregulating the labour market, so that can called removing the minimum wage, is basically saying that we're going to provide a stronger incentive to get an education, we're going to provide a stronger incentive for people to get into high-skilled professions, we're going to reduce firm costs of production, but on the flip side, it can hurt equity because people are only getting paid if they have certain skills. So deregulation involves removing the minimum wage, but it also includes paying people for performance and basically tying wages to the performance of their output or their work. This should help to reduce real unit labour costs because people work harder and increase productive capacity. So a lot of these policies, removing the minimum wage, deregulation, all these things are all associated with trying to lower firms' costs of production and encourage productivity. Costs and benefits of market approaches, they often promote efficiency but come at the expense of equity or fairness. So all these things like removing the minimum wage, health and safety laws, environmental laws, they can often lower firms' cost of production, but they can make the more vulnerable members of society more susceptible. It can also lead to more pollution, which can hurt us in the long term. Market-based approaches therefore need to strike a balance between increasing aggregate supply, but also ensuring they don't erode our living standards because it hurts equity or because it can hurt the environment and things like that. Okay, so to summarise before we do this question, interventionist approaches generally are good for equity, but they're bad for the budget, and that includes things like education and subsidies and infrastructure. Market approaches is about the government removing their intervention. It often hurts equity because a lot of those policies were in place to improve equity, and that includes things like deregulating the labour market so people get paid based on performance, removing the minimum wage, removing environmental laws would be another one, and then the main one we've probably looked at in class is tax and welfare reforms, all about removing taxes and reducing welfare. Explain how a market-based policy can achieve a more flexible labour market and improve efficiency in the allocation of resources. Okay, so a flexible labour market means people can move between jobs, and a market-based policy means the government's not intervening in the market anymore. Explain how it can improve efficiency and make a link between the two things. So a market-based policy, unlike interventionist policies, involve removing government regulations and allowing market forces to achieve efficiency without government intervention. An example would be in labour markets, removing regulations such as unfair dismissal laws would give employees more flexibility to dismiss people that are no good at their job. That will help to boost labour productivity because people fear dismissal, and you can also get rid of the employees that are no good. So employees may increase their intensity of effort in the knowledge that they may be dismissed more easily if they underperform. This should help to increase productivity. This should lead to an increase in labour productivity and a more technically efficient allocation of resources. This would one where existing labour resources are more likely to producing output at maximum productivity and lowest cost. So a good example to encourage flexible labour markets, you explain what a market-based policy is, getting rid of government intervention. This can include deregulation and getting rid of unfair dismissal laws. This would then boost labour productivity and increase effort, and that should help to achieve a more technical efficient allocation of resources. Other questions you might get, explain the difference between market-based and interventionist approaches. So for market-based, you talk about removing government intervention. That can include deregulating the labour market, getting rid of the minimum wage, lower company and income taxes, all designed to promote productivity, as opposed to interventionist supply-side policies like education and infrastructure, and subsidies, which still work to boost the quality of our resources, but do that by the government intervening, which can often cost the government money. So one of the benefits of supply-side policies is that they don't always have to cost the government money. These market-based approaches don't actually cause a government outlay. Explain why research and development, education and training are all examples of interventionist policies. So explain that these all involve the government intervening in the market, so producing basically government funds, and then explain why they do this. They do this to try and promote positive externalities because a lot of these things are under-allocated in the free market because producers don't consider the third party or external benefits of their transactions. Subsidies and interventionist approach is because it involves government intervention to try and boost supply, so to encourage research and development or education, etc. Removing a subsidy is about a market approach, which can often occur because subsidies can encourage inefficiency because businesses aren't exposed to competition. Deregulating the labour market is a market approach because, again, it involves removing the minimum wage, putting pay based on performance, and getting rid of government intervention in the labour market. It boosts aggregate supply because it encourages people to work harder and more productively so that they can, because it's easier for them to get sacked, there's no minimum wage protecting them, and that can all lead to reduced cost of production and more willingness to supply. Thank you.